Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
All right. Good afternoon. Good evening, everybody. Thank you for joining us on our podcast. All 50 to 100 to 5,000 users. Hit the like button. Maybe I'll get sponsored by Doritos. I'll get you get a free bag in the mail. Okay, I'm not funny, but I'm here today with Paul Gardner.
How are you?
Good. How are you?
Good. It's nice on a snowy day.
Yeah. It's nice. It's been a while since I've been on with you.
Yeah, exactly.
Or on in general.
Well, we got some stuff to talk about, don't we?
We do. I don't even know what we're talking about today.
We could talk about the Raptors. We could talk about bond yields, stock markets, yes, whatever you want.
Stock markets, inflation, bond yields.
Can't talk about the leaves, though.
Governments, geopolitics. No, we can talk about anything you want. But one of the things I think would be a great conversation today and very topical, because the inflation number just came out with CPI and PPI, is this whole inflation narrative, and rates are going to, the financial media economists suggesting that rates eventually roll over in the second part of this year, and looking at the inflation data and a few scenarios where interest rates have to stay higher longer or even tick up. It's not impossible, but it's contrary to our own narrative.
Like I said, the narrative of the last 6 months has been, the bond market in the fall last year basically took the lead, saying, well, inflation is falling from, let's say, 7% down to 3-4%. And that was correct. And then you take the lead and go, okay, well, rates are going to drop sooner than later. But not so fast. Like we've been seeing numbers over the last, say, 2 months that are certainly stronger than expected. Almost disappointingly, from a bond market perspective, we have seen employment grow, not decay. We've seen service side inflation start perking up.
Well, that was today's reading. That was today.
So it's topical because we had U.S. CPI and PPI, Producers Price Index, and the U.S. Consumer Price Index out this week, and they both were, as they say, hotter than expected. And when you really kind of look through the numbers, there's a lot of one-offs, and they're going to be amended and all that stuff. But when you look at the trend, one kind of disturbing thing that they saw is food and energy, which is always volatile. They saw some perk up in inflation due to service costs, and that's one of the things that it's very hard to judge. We're now a service industry. We're less of a goods industry. And the trouble is you can't really project what the service side is going to inflate with, because companies are trying to keep their margins high, right?
So to the average person out there that consumes goods or services on the service side of the economy, whatever that service may be, maybe it's business to business service.
I'm talking like lawnmower cutting.
Or residential service. You get your lawn cut.
All that stuff is going up.
Your kids in tutoring.
Yes,
you're seeing
it's all going up.
Pressure on that side of the economy.
Yeah, and we were hoping it was going to fall. The goods side seems to have been coming off because that's a little more in a slowdown or recessionary. But there's a couple of factors that are really causing problems from the bond market to digest. Is one, we really need to see us going through 3% inflation, not only in Canada, which we probably will, but also in the U.S. Sounds to me more like a problem in the U.S. The economy is running hotter there, just because of a couple reasons. One, like the Inflation Reduction Act, which is
the Inflation Reduction Act, which in turn
it's just an infrastructure spend,
which runs massive budget deficits and creates more inflation.
Yeah, so that's getting in the way, and then unemployment is not going back up, and wages are, I would say, are higher certainly, but they're not coming back down.
But so it's really hard. Me personally, I would have thought the economy would have rolled over more aggressively over the last 12 months or so. But you just have two competing forces with central banks raising rates and keeping rates higher longer. And then on the other side, you just have governments running these massive deficits and these competing forces that are leading to having to leave rates higher for longer. It's hitting the service side of the economy, and it just makes you realize that it's not a for sure thing that rates automatically roll over or they can stay higher for longer, or heaven forbid, tick higher. And one of those things that we talked about earlier today was just the supply demand fundamentals on demand dynamics on the yield curve.
Yeah, that's a whole nother level. Just going back to your points about how we're not seeing this tick down, and there's a lot of factors that are affecting it. Let's break it down, like in the sense that in Canada, up until the government announced they're going to cool down immigration, we were getting 500,000 people a year coming into this country. So that does amazing things to, first of all, it's generally positive because we want people coming in here. But secondly, it's a negative because they're creating more demand. So why the government's trying to slow down through higher rates, you're also bringing more people in, which buy more goods and more housing. And, we all know the headlines about housing.
And then infrastructure.
The second thing is that you have the U.S. and Canada, for that matter, converging from the environmental movement, moving out of moving into renewable resources. That takes billions upon billions. We know about that. And that's creating demand as well for companies and for hiring. And then finally, you kind of mentioned it, that the government in a perfect world, let's look at the U.S. example. They're still growing at, say, 2 to 3% GDP growth.
Yeah.
But they're still running deficits.
But you're spending 5 to...
Yeah. And their deficit is going to be close to $1.5 trillion this year with a growing economy. And the biggest problem
sorry to interrupt, but they've stated over the next decade, I think a good base case scenario, they're going to bring their deficits to $50 trillion.
Well, there's a number floating out there, but it's just...
And that's without a recession.
Yeah. The problem is you're going to reach a tipping point. Right now, a third of all budget expenditures is interest costs for the Americans.
And
once you get that, and there's a couple of other things.
Medicare, Medicaid spending, defense spending, the interest on the debt, and you're just having to run these massive deficits to even get it to 50 trillion. You're assuming that there's no recession and over the next decade, because most of the spending is legally mandated in a sense. You got to fund the military. You have to fund
And the problem is there'll be a tipping point. There's two things that are coming at us very quickly. Is one, Social Security in the U.S. is supposed to go bankrupt or without any value by 2028. So they got to do something there. And two, interest costs could get to 60-70% of a budget. And once that gets to 50-60%, it's over. It's literally over.
And none of this also takes into account the reshoring that's occurring. And the stats show that reshoring and manufacturing is happening. It's going to continue to happen over the next decade. That means that you're adding probably 1 to 2% in inflationary pressure over the next decade.
Because you don't have China to kind of bail you out on deflationary.
Absolutely.
Right. So there's a whole confluence of situations that are like at minimum keeping the inflation rate higher than it is, and the trajectory or the easing of inflation is slowing down, meaning that it's still bubbling up to 3.5, even if you're bullish on inflation. And that's a big problem because you're not going to get rate decreases from the central banks until we start seeing numbers.
I think with the government spending that's going to occur over the next decade, it has to occur because of the level of debt that governments have. I think in the reshoring that's going to occur and all these dynamics, it's very obvious to me that inflation will be higher over the next decade, but that doesn't mean it's a linear thing. The problem is the pathway to inflation over the next decade may include assets going down first and inflation really rolling over and rates being cut or going into a deeper recession before governments, maybe they introduce a basic income or run further deficits, and then you have further inflation out of this.
No, okay, so we should kind of put a disclaimer that we're kind of at Avenue, we're kind of leaning towards that theory, but we're not putting all our money towards it, meaning that there should be rates coming down
Yes.
sooner than later. And if the economy slows, then the central banks will be able to lower rates.
Yeah.
So you got to kind of prepare for that. But we're saying, what if that doesn't happen? And
Yes.
certainly the risk return is on the risk side is on what I call an unanchoring of the yield curve. And what I mean by that is there's so much supply of bonds, and let's say inflation stays 3 or 4, that the long maturity bonds, and we consider that, say, 10 years and out, will start moving higher. And that will destroy capital. That'll destroy a bit of real estate. That'll destroy companies' balance sheets, because people can withstand this recent rate hike and pay 5, 6, 7% interest rates, but I don't think many people can afford 7, 8, 9% interest rates.
But that's why a large portion or the bulk of our bond portfolio assets are in shorter dated,
as a strategy,
investment grade corporate or government credit.
So it's just if we talk about our bond portfolio for a moment, so we really focus on corporate credit, investment grade corporate credit, which we mean triple B low and higher.
All that means is companies with good credit ratings.
With good credit ratings. And we always figure that the 2-year piece is not only good from an interest rate perspective, but you got this lift from owning the credit itself, like an extra 2 percentage points of yield. So that's a great position.
And you're not being compensated to really take the risk to go farther out from that. Where if you're going 10 years.
No, we do have to buy longer duration bonds.
Yes,
to offset the shortness of our portfolio, because we don't want to be too underexposed to the interest rate movement.
Yeah, so I'll summarize it. That's too much technical jargon.
Sure.
This is we're really bad at this. Okay, so let's try this again. What you're trying to say is that we have to own some longer dated bonds, even though the bulk of the portfolio is in shorter dated bonds, to manage the interest rate risk in the portfolio. So if rates go down, your longer bonds rally more.
Yeah. And that's a great way of putting it. You have to have some exposure to it, because otherwise you're susceptible. As I said, in the case of if rates drop, you have nothing with you.
Because from time to time, someone will call up and say, "Well, I'm 75 years old.
Yeah.
Why do I have a 10-year bond? I might be dead in 10 years."
Yeah, kind of. But it's a whole about the structuring of the whole overall portfolio
and how you're managing interest rate risk.
Right. Yes.
We can talk about that another time. But the bulk of the portfolio is in investment grade, corporate credit, 2 years and under. There's a lot of maturities occurring, and we'll see where rates go from there. And if rates do roll over, you would see some gains out of the bond market, which is a positive thing. But I mean, it's a very interesting time to be an investor.
Well, it's one of the largest subjects that's really no one still talks about, which I find confusing, is in the U.S., as we talked about, they're running massive deficits. There's a point in time where they're not going to be able to pay back their deficit. And of course, politically, both parties aren't even coming close to talking about it. About cutting spending, about raising taxes, because there's only two ways of getting on side.
In Canada or U.S., it's not a Republican Democrat thing. It's not a liberal conservative thing. You've had 50 years of government that have run massive deficits for long periods of time and overspent. And if
less so in Canada, though.
Less so in Canada. Less so in Canada. But if you're a politician, you put your hand up and said, "Hey, let's have austerity measures. We've been lying to you for 50 years. We need to cut cost, and our standard of living or the government services is not sustainable," you'd be labeled a radical and thrown out.
But I'm really specifically talking about the U.S. because we had our moment in 1995 where we cut our spending across the board and we got on side. We're not perfect and we're not close to, we're still only debt to GDP is only about 40% after the pandemic, whereas in the U.S. it's reaching 75%.
Yeah, but that doesn't include the provincial debt.
Well, yeah, but then the government in Canada, I don't know if they backstop the provincial debt, so I don't know if that's fair.
So what would you think would happen if Ontario or...
Well, I don't think the government of Canada would basically I don't think they'd back their bonds. But then again, there's history towards it because I think in Newfoundland they basically backed it. But the biggest issue is the U.S. Like the numbers are so confounding, and the fact that no one's talking about it. Like there is an end date. Also, you have a confluence of entities, countries like Russia and China that used to be big buyers of Treasury, and they're not.
You've run these massive deficits. You had a decade or many years of effectively zero interest rate policy, running massive deficits, creating new money supply, and you've really hurt the middle class. The cost, you've driven up asset prices. You've hurt the middle class in society, and where do you go from here?
Well, that's the big question. Is that eventually you're going to have to pay the piper. Eventually you're going to have to either cut spending or pay higher taxes, and that's where it's confounding because the one thing, the U.S. is a reserve currency, so they can get away with this as long as they can get away with this. But my feeling is that there's a risk. It's not a sizable risk, but it's a risk to talk about that. If the yield curve in the long run becomes unanchored and goes higher, that will destroy not only the stock market, but destroy balance sheets.
Well, on one hand,
that'll be the whale, that we're talking about, with no one talks about right now.
On one hand, we understand why we have to stay invested. We need to own companies that can raise prices or reinvest in their business, grow their earnings over long periods of time. So there's more demand for the stock, and you keep as much of your purchasing power intact. But at the same time, we choose to hedge for the majority of our clients against a tail risk because the pathway over the next decade of earnings going higher may include assets going down first and a credit event or some sort of shock to the system. So that's why we're always trying to constantly come up the middle. So anyways,
just try to do it as safely as possible, I guess.
Is there anything else? I'm getting bored of this conversation. Is there anything else interesting you want to talk about? You want to talk about real estate? You want to what about residential real estate? I was just out in Calgary. Their real estate market is on fire in certain pockets. It's doing well in Quebec, and it's just not the same in Toronto, Vancouver.
It's immigration, and Calgary and Montreal are still reasonably priced.
Yeah,
and you can afford to go higher, I guess. Remember, rates have come down a little bit since the highs, and it's once again this immigration thing is providing such stimulus to the housing market. You
know what really scares me? This is a little bit of a tangent. The amount of clients, investors, potential investors that I speak to, my own social circle, that have said, well, I would like to sell my home in Toronto. This is not really an Alberta thing, or my investment property or my condos or my building. But, I'm going to wait for interest rates to go down. Therefore, my real estate valuation will go up, and for sure I will be able to sell this in the spring or next year at a much higher valuation, which is kind of flawed logic in my view, because if you're cutting rates in a deeper recession, the reason why you're cutting rates, that might also mean,
but it also helps
assets
financial
go down.
Assets, though. But you can make the case that they go down.
But it's not a 1-for-1.
No, it isn't
relationship like it has been in the past, where you're in a growing economy, rates fall, and anyways, I just find that interesting. That
I mean, regional banks in the U.S. are going to have some problems with real estate loans. In Canada, not so much, because the banks have so much control and discipline that they'll take a little bit of a hit, but they're still going to get their money out of it. REITs, because I do focus on REITs with Avenue, is that we think there's it's time to start buying the depressed, we bought Allied, but not that, and Allied's pricing is not going to move for months, if not, quarters.
Yeah.
But you got to wait for the next cycle to kind of turn to hit, but you're still buying properties that are trading at a discount, even after write-downs of their properties. Yeah. So we think there's some value there, but I wouldn't go all in. I still still think apartments and industrial is probably the best spots to be in, but even those stories are getting a little tired.
Yeah, and the commercial, I don't know if it's investable at this point in time.
I don't know if it's either. Like the office, I still don't think it's investable.
is that sounds extreme?
Allied's a little bit of a different. It is office, but it's a kind of a different venue than say large towers in the cities in Canada.
Yeah. One other thing we're talking about. Here's another question. We're talking about rates. We're a little bit disorganized in this conversation, talking off the cuff, jumping around a bit, but just once again hitting over the head the whole reinvestment risk, which is, the risk-free rate of return. I could get 4.9 in a T-bill. Why don't I just put my whole life savings in T-bills and then, buy back into the market in 3 years or
it's
4
elegant,
years?
if you can do that. But,
I wish it was so. Just saying.
The problem is if, and once again, I'll say that there's a real risk rates go lower. It's actually probably more of a risk. I'm just saying we're not convinced yet. So we're really, I would say, really neutral. But if rates go lower, your T-bill rates or your GICs will not be at 4.8%. They'll be at 3.5%.
Yeah, and then,
so then, are you okay with earning after tax, after inflation?
After inflation and
you're
taxes,
basically zero.
Yeah, after inflation and taxes.
There's a need for the bond market, and there's a need for investments like that just to be safe. But you really have to kind of think about where we're going with this, like in regards to interest rates. And if they do drop, that will benefit existing owners of bonds. But if you're short term, then they mature quickly, and then you're reinvesting at lower rates.
Maybe they don't tick down as much as you think.
Yes, and I think
and then inflation runs higher.
I would be in that camp,
and then
I think
inflation
we both would be in that.
Yeah, and then inflation runs higher, and you want to be able to own assets that can reinvest in themselves and grow their earnings or protect their margins or raise prices.
One thing in the stock market, companies can, if they're good at it and if they have the ability to, they can raise prices to keep their margins. A bond itself can't raise prices. You're locked in. So you have to deal with the inflation component. But at least with companies that, especially young companies like technology companies, they can just increase their prices very quickly.
Yeah. Well, I think we should change the format of this a little bit. I challenge anyone that actually listens to this to send an email.
Yeah.
And we can talk about anything you want to talk about. If you want to talk about commodity investing, I think I'm going to do a podcast with Bill on that in terms of, gold, copper, what's happening, if they're a good hedge of inflation, what's happening, the dynamics in that market.
We're finding some really good U.S. stories, and Brian and Eric are finding some great stories. That's something, that's
bring it to the team and sorting through all of this, and that's more in the mid-cap U.S. space, but it's been a good start to the year. Knock on wood, and thanks again for listening. Okay, that's it. It's a
great weekend.
Is it a family day weekend in Alberta?
No, it's family day everywhere.
Is it everywhere? Is it a Canadian thing or provincial thing?
It used to be only in Alberta, but now
I think last year
we took a good. I think last year I did
meetings on family day.
We take several good ideas from Alberta.
Alberta is honestly very dear to my heart. It's a great place.
You go there now.
Okay.
All right.
Thanks.
Have a good long weekend.
See you.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.